Welcome to our deep dive on how to keep every tax-free dollar in your flexible spending account, especially your Dependent Care FSA, at year-end. Today we will cut through confusion about paycheck timing and the run-out period so you avoid forfeiting money. We will start with the core pay date rule, then move into how to use the run-out period, and finally give you an action plan, case study, and quick quizzes. Let's begin. Here is our agenda. First, we will cover why year-end timing is risky. Next, we will explain the critical pay date rule. Then, we will show how the run-out period can help you file claims after the plan year ends. After that, we will provide a step-by-step action plan and a practical case study. Finally, we will test your understanding with quick quizzes, highlight common pitfalls, and wrap up with key takeaways. This content is educational and general in nature. It is not tax, legal, or benefits advice. Policies and deadlines vary by employer and plan administrator. You should confirm your plan's official rules, pay date policy, and run-out period directly with your employer or plan documents before taking action. Here is the problem. The plan year may end on December 31st, but your final paycheck for the last December work period might be dated in early January. That mismatch creates confusion over which plan year gets the deduction. If that deduction is taken in January, it is typically tied to the new plan year. If you did not elect coverage for the new year, that deduction should not happen. This timing can cause both cash flow stress and potential forfeiture, if not corrected promptly. The critical pay date rule states that contributions are tied to the paycheck date, not the dates you worked. Therefore, if the plan year ends on December 31st, but your paycheck is dated January 1st or later, any Dependent Care FSA deduction belongs to the next plan year. If you did not elect a new year election and a deduction still occurs, it is typically a mistake. You are not necessarily out that money. You should contact your employer's payroll or benefits team immediately to verify the deduction schedule and request a correction or refund as needed. Do not wait, because payroll cycles can complicate the correction if delayed. To correct a wrong deduction, first confirm the paycheck date and the pay period on your pay stub. Next, check whether you actually elected DCFSA for the new year. If you did not, and the deduction was still taken in January, email payroll or HR immediately. Reference that contributions are tied to paycheck date and that the deduction should not have occurred for the prior year. Request that they reverse or refund the deduction or apply it correctly according to plan policy. Ask for written confirmation and a timeline. Finally, monitor your next pay stub and your FSA account balance to ensure the correction is completed. This timeline shows the plan year ending on December 31st, followed by the run-out period that begins in January. During the run-out window, you can submit reimbursement claims for eligible expenses that were incurred by the end of the plan year. Many plans set this deadline around late March or April. After the run-out deadline, any remaining unclaimed funds are forfeited. The key action is to verify your plan's specific dates, because employers and administrators can set different deadlines. The run-out period allows you to submit claims for eligible expenses that were incurred by the plan year end, typically December 31st, even though you submit them in the following months. Many plans allow claim submission through March or April. You can still submit during run-out even if you are no longer contributing. To succeed, keep itemized receipts, provider statements, and proof of payment. Submit early and track confirmations from your administrator to avoid last-minute issues. On the left is the pay period, which reflects when you worked or when services occurred, and often spans 2 weeks or a semi-monthly schedule. However, the pay period is not used to determine which plan year receives the FSA contribution. On the right is the paycheck date, which is the date on the actual check or when the direct deposit posts to your bank. The paycheck date controls which plan year the FSA deduction belongs to and is the basis of the critical pay date rule. This table summarizes the life cycle. Plan year end on December 31st is the last day to incur eligible expenses. On January 1st, the run-out period begins, which opens the window to submit prior year claims. The run-out deadline is often March 31st or April 30th. After that, any unused and unclaimed funds are forfeited. Your actions include scheduling services before the year end, gathering documentation, submitting all claims before the run-out deadline, and verifying confirmation to avoid forfeiture. In this scenario, the plan year ends on December 31st. The last work period is December 15th through December 31st, and the paycheck is dated January 3rd. Under the pay date rule, the January 3rd deduction belongs to the next plan year. If you did not elect DCFSA for the new year, that deduction should not have been taken. Contact payroll or HAR to request a reversal or refund, or to apply the deduction correctly. Meanwhile, you can still submit claims during the run-out period for eligible expenses incurred by December 31st, up until your plan's run-out deadline. Quiz time. Which date determines the plan year for a Dependent Care FSA deduction? Option A is the pay period end date. Option B is the paycheck date. Option C is the date you scheduled childcare. Option D is the date you submitted your claim. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, the paycheck date. Contributions are tied to the paycheck date rather than the pay period, the scheduling date, or the claim submission date. Here is another question. True or false? You must submit all Dependent Care FSA claims by December 31st or you lose the money. Option A is true. Option B is false. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is false. The deadline to incur eligible expenses is usually the plan end date, but the run-out period typically extends into the next year. You can submit reimbursement claims during run-out for expenses incurred by the plan year-end. This flowchart shows a stepwise process for fixing a wrong deduction. First, review the pay stub dates. Then, check whether you made a New Year election. If there is no New Year election and the paycheck date is January 1st or later, notify payroll or HR. Provide documentation such as the pay stub and election confirmation. The employer processes a correction or refund. Finally, verify on the next pay stub and in your account. If you did make a New Year election, then the deduction likely belongs to the new plan year and you simply monitor for accuracy. These are common pitfalls. Do not assume the pay period controls the deduction year. Do not ignore a January paycheck that took a prior year deduction. Address it quickly. Do not miss the run-out submission window. Keep all documentation, including itemized receipts and provider information. Finally, always verify your plan's specific dates and rules with your employer or administrator. To summarize, the paycheck date controls which plan year receives your Dependent Care FSA deduction. Use the run-out period to submit prior year claims, typically through March or April, for expenses incurred by December 31st. If a January paycheck takes a deduction and you did not elect the new year, request a correction or refund from payroll or HR. Track all deadlines, keep your receipts, and confirm details with your administrator. Thank you for watching. If this helped you avoid losing money, please like the video, share it with a coworker, and subscribe for more benefits and money optimization tips. Post your questions and experiences in the comments so we can help you fine-tune your next steps.